Welcome, everyone. Thank you for joining us today. I'm 𝗖𝗣𝗜 Biniaz. I'm joined by my wonderful partner, 𝗖𝗽𝗶 Benesocky. Welcome, 𝗖𝗽𝗑.
Thank you, August, and hello, everyone. Thank you for joining us. Today, we're joined by Rick Genovese. He is the founder and CEO at 𝗖𝗽𝗶 Capital Ventures.
Perfect, beautiful.
I'm just going to quickly go ahead and give a background about Rick. Rick has a deeply rooted entrepreneurial and leadership persona. With his first venture into corporate business ownership at age 22, same age I started business, was when he founded Genovese Construction Ltd.
Oh, he's got a background in construction,
yeah,
like me?
Like you,
okay,
yeah.
cool.
Yeah. He is the CEO at 𝗖𝗽𝗶 Capital Ventures, where he focuses on high-yield multifamily investments. So Rick has developed the status of a trusted advisor in the local real estate investing community, which led him into be invited to co-host Synergy real estate education events with his investor co-mentors and business associates for the group's 1,000+ members.
Wonderful.
That's
great.
a really good
Welcome,
turnout.
Rick. Welcome.
Welcome.
Thanks, August, and thank you, 𝗖𝗽𝗶, for the incredible introduction. Yeah, I'm grateful and humbled to be here.
I appreciate it. Yeah.
So Rick, why don't you start off by kind of telling us about what it is exactly that you do so that the viewers can get a really good idea.
Yeah, so I create amazing real estate investment opportunities for investors. I do that by acquiring apartment buildings and commercial properties, industrial properties, and/or building them and acquiring the land, doing land assemblies, building them, and then sharing those investments with investors. And you know, the investors are anyone from, you know, the plumber down the road, my neighbor down the street, my brother, my accountant, you know, my lawyer, basically everyone, everyone that I know, I reach out to and offer opportunities to invest to, because they're, you know, the investments that I create generally are double and triple digit returns. So, and triple digit returns are pretty hard to find, but I know how to create them.
Awesome, awesome. And we'll get into that. So you're kind of what we call the good old syndicator. In our world, we call them apartment syndicator or real estate syndicator. Syndication is when you bring the knowledge and experience with the capital, and you combine these two groups, and it creates a syndication, and you conduct a business. In this case, being real estate. So yeah. So to tell us a little bit about maybe your background and just briefly on a high level, what is your main focus as far as what type of multifamily, if it's already built assets that you acquire, or on the development side, kind of go over what areas and what type of the projects you look at.
And really quick, Rick, I think that August wants to know a little bit about your construction background.
Yeah, so okay, so I'm not going to start from birth. I think that's too early, but I'll start from you know, like when my first construction business, Genovese Construction Limited. I started that business when I was 22. I didn't even have my journeyman carpenter's ticket at the time, but because I'm an entrepreneurial person, it was just natural to me to create a business. And I had already been contracting for a number of years, but of course incorporated at that time because that was the advice of my accountant. At that time, I was not all that knowledgeable about business. I was entrepreneurial, but without the education, training, the background, someone to mentor me, you know, it was a slow start. I learned a lot, but it took a long time for me to really get traction and to understand. I had to meet the right people, people who were doing what I was really passionate about, which was building apartment buildings. As the years went by, I started out building single family homes, tract houses, Maple Ridge, different places like that, and all over Coquitlam, and moved from there into contracting, mostly concrete structural, underground parking garages, that sort of thing, multi-level parking garages, and then doing, you know, the framing of the apartment buildings or townhouses above. And I always said to myself, I want to own these buildings, but I had no idea how to do it back then, until I met a particular person. I met a fellow named Robert Symington, and Robert invited me to a mastermind group. That was in 2010, in October of 2010. he invited me to a mastermind group, and they were talking about buying condos, buying small apartment buildings, buying duplexes, triplexes, whatever. And they had this formula that they were using, these, you know, spreadsheets for analytics, all this sort of stuff. And within 4 months of seeing that, I bought my first building.
Nice.
Wow.
That's all it took. That was the catalyst. Really, it was the missing link. I had the passion, I had the drive, I had the energy, I had the you know, I had the background knowledge that I needed. It was just the formula that I didn't know. And so once I got connected to that group, I took off. I bought 2 buildings in that first year. And then it took a little while for me to stabilize that. And then I bought a third building in 2015, and then another building again in 22, 2 buildings in 2015. That set the foundation for me really to become financially independent. And then at that point in 2015, late in 2015, I got approached by a group that was starting to build apartment buildings, moving from ownership of apartment buildings, being landlords, acquiring existing apartment buildings, to real estate developing and building apartment buildings. So they pulled me in to help them, which was my leap out of the day job. So I got out of the doing both, where I was had a day job, which was it was construction oriented. I was construction manager, and then I moved into sales and after sales. And in that business, you know, because I'm so entrepreneurial wired and I'm obsessed with growth and productivity, I came into that department in that business in after sales and sales. They were doing $100,000 a year. And in the 5 years I was there, I worked with them to scale it to $6 million, which was, and 17% profit. The rest of the business was doing about 3% profit.
Wow.
And so, I took that and I said to myself, why am I doing that for these people? I got to get out of this. And so that was my stepping stone out of that business to being not completely independent at that time, because I was still working with someone else. It was a partnership deal. So I did get a partnership in the 191 unit apartment building that we were building, which was in Langley. And so once we completed that and it sold to a REIT, I jumped out of that business and I just said, I'm done. I'm going to go do this on my own.
Nice.
A better way.
Awesome.
Nice.
Awesome. And
on
your first project that you started, where was that project located? The first multifamily or apartments that you purchased?
Windsor, Ontario. So my foundational real estate portfolio is Windsor, Ontario. I went to Windsor, Ontario. You guys know Don Campbell?
No.
No.
We
Don
don't.
Campbell is REIN, you know, our REIN, REIN.
Okay, yeah. I think
So
the
REIN is Don Campbell is the founder of REIN, and then he sold it to a group of consortium. And anyways, so Don Campbell, and he's legendary, right? He wrote the book, I have it on my shelf there, Real Estate Investing in Canada, and a bunch of other books. And you know, a legendary guy in the real estate investing circles. So anyways, I'm at an event, Don Campbell's there, right? And of course, REIN is all about Alberta, and I'm investing in Windsor, and it's not on their top 10 list, right? And so I approached Don with his book, and I said, Don, will you autograph my book? And he says, oh yeah, so where are you invested? I said, Windsor, Ontario. And he got this look on his face like, why would you do that? But you know, the way I looked at it, because I'm very data and I make decisions based on data, you know, so to go back to how decisions are made, right? So decisions are made, you do things based on emotion, but you back them up with data, right?
Yeah.
And so I had the emotional drive to build apartment buildings. I needed the data to support, you know, my decision making. So I found the data. The beauty of Windsor is it's a big enough town that it's on CMHC's radar. So there's a ton of data. So there's also an economic council for Essex County in Windsor that produces data every year on the economy. What I saw in Windsor was that the 2008 financial crisis was an anomaly that had never been repeated in history in Windsor. Two automakers shut down, and the city was reinventing itself. And the dollar was at par. And so there's a perfect storm for a city. And I said, you know what? This city is going to come back. And when it does, whoever's invested here is going to make a lot of money. So I started investing in Windsor. And that's what happened. In 5 years, I more than doubled my money. I tripled my money. Yeah,
no, we know about a lot of teams that do invest in Ontario, and there seems to be definitely a need in single family and multifamily. As everyone knows, and yourself, Rick, we're focused on doing similar kind of concept, but in the US, purchasing already built apartment communities and upgrading them and exiting them in a few years. So it's great to have someone who does this on this side of the border, that our investors and our viewers, our associates can see and kind of connect with, and kind of pick your brain on how it's done on this side of the border. Because as one of our viewers just wrote, is how do you find those opportunities, especially in BC where current cap rates are very low? I guess you already answered that your deals are in Ontario, but what we noticed here in Canada is that rent to value ratio, it's just not there. So on a 70-30 LTV, when you put down 30% and you borrow 70% from the bank, on the rents you collect on that asset, you have a hard enough, you'd be lucky enough to pay for your mortgage payment on that 70% you borrowed, let alone what they do in the US, pay that mortgage payment, pay the taxes and fee, pay the property manager, and pay their investors 8% pref. And that was the impetus for us wanting to move to the US and looking at US assets. So if we can hear from you of how you did it, and kind of, obviously we're on somewhat of a time restraint, but if you could kind of on a high level explain to us, how did you find the deals, and the process of, was it a value add or development, would be great as well.
Yeah, so all of the properties were value add. So there was nothing that I acquired that was, an 8 cap or a 6 cap on the day of purchase. They were underperforming, undermanaged properties with a lot of deferred maintenance. So the opportunity there was pump some capital in, clean up the buildings, bring good tenants in, fill the building, and increase the NOI and the value, and then you've got a cash flowing property. But those things don't really exist in BC. BC is a place where everyone wants to live. It hasn't gone through an economic crisis really, and so that opportunity is just not there. And because of the stability of the market, cap rates get compressed because there's safety, right? So cap rates get compressed for a couple of reasons. One is, the interest rate, depending on, the lower the interest rate in the bond market, and in apartment buildings, the more compressed cap rates will get, because there's not as much debt service that has to be paid out of that NOI, right? And then the other part of it is safety, where there's a lower perception of risk, then people will pay more for that property because they don't see it being a risky investment that is going to take a correction at some point.
Exactly. It's similar to the Vancouver, is similar to the Californias and the New Yorks, where historically have had low cap rates and everybody wants to be there. Now, on the deals that you did, were these syndicated? Did you raise capital from investors to purchase them? And kind of walk us through that process.
Yeah, so on the first two properties, which were 2 sixplexes, I bought the 2 properties with my own money. I took lines of credit out, I remortgaged my home, used all my savings, took all my RRSPs out. I went all in, and every penny of that went into those 2 properties. The next property I purchased, I syndicated. So I met an investor while I was renovating my original properties, the 2 sixplexes that I purchased, and that was through one of the meetup groups. I think it was Michael Ponte's group. Anyway, so I met that investor there. She was interested in working with me. She was also invested in Windsor, but was looking for other projects to invest in Windsor as well, and someone to kind of take over that had the knowledge of of how to improve the buildings, because she didn't have that knowledge and she was having trouble with contractors, etc. So we partnered on 2 buildings and bought 2 buildings together. She brought the cash, I brought the knowledge and the and the management. So basically, I'm the asset manager. She lives in Hong Kong now, and yeah.
Great, wonderful.
Got a team going. That's what we're.
Yeah, for sure. Yeah, no.
But that track record is what gave her the confidence in me, right? Because I was already invested there. I had basically leveraged everything, put everything in, and said, you know, this is the place to be. And you know, then there's the hidden opportunities that you find along the way, right? Like one of the properties was a row house of townhouses, and what I did is I severed title on every second unit, which turned them all into individual title. So basically, it was one title of 6 townhouses. I severed title and doubled the value overnight like that.
Wow. Nice.
Because it went from multifamily value to single family home value.
Great, great. Do you also focus on larger assets? Like in our criteria for the US assets we get involved with are 100+ units. So kind of discuss that with us. As are you looking at, or have you been involved with larger assets?
Yeah, no, I haven't done it. Well, 𝗖𝗣𝗶𝘁, that was the property that we built in Langley, was 191 units. My current building that I'm building right now, which is in the Victoria Capital Regional District, is 32 units. The next parcel of land that we have is going to be 5 lots, or about 45,000 square feet. And so off that 45,000 square feet, we're probably going to be able to do 160 units there. So we're going to be moving from, so the thing about scaling up is that the bank's got to be confident that you can get there and that you're not taking too big a leap. So everything we do answers to 2 questions. Will the bank support it? And how do we present it to the bank? What's the maximum we can squeeze out of this property in its highest and best use, based on the theory that every penny on the cap rate that you gain in rent by adding attributes to the building pays you back in NOI at the end, and valuation over cap rate.
And is the end goal for all of these projects to be tenanted buildings, or is there any sale of separate units kind of?
Yeah, so we strata title all the properties. Any new property we build will strata title. That gives us the opportunity. It will start out operating them as apartment buildings. Once the CMHC mortgage matures, say it's a 10-year mortgage, in 10 years, because it's strata titled, we have the option then to either sell as condos. We can remortgage with CMHC, put another 10-year mortgage on it, and operate it as an apartment building. We can sell the entire building. We can sell it units. So you got lots of options. So that's the one thing that I see quite a few developers do, is they don't want to spend the, what is it, $110 or something like that, or a unit or something to CMHC mortgage it, or the condo. I'm trying to think what the condo fee is. I think it's $750. The condo fee is $750 per unit or something. They don't want to spend that, so they don't stratify it. And then the problem is that if you operate it as an apartment building now, but it's not strata titled, you can't strata title it in the future, because strata titling later on means that it has to fit the Rental Tenancy Act's idea of what's acceptable for strata titling. So in other words, what the Rental Tenancy Act says is if the vacancy rate's not above 4%, you can't strata title a property that's an apartment building. They lock you in. So you have to do that before, right at the beginning of development.
Great, awesome. And you mentioned something. I'm kind of familiar with CMHC and CMHC loans and how they come into play. But if you'd like to kind of, on a high level, explain to our viewers, what is why was the reason that CMHC loans have been created? How are they funded, and what is the purpose of them, and how can developers take advantage of them to build communities and more living homes for people?
Sure. Yeah. Well, my good friend Andrew Bennett at Nexus Investments is the guy I go to for those answers. His answers to those, because Andrew Andrew can write CMHC mortgages directly to the pension funds. And so he's one of the very few in Canada that can actually write CMHC mortgages without having to go to RBC or somebody like that, right? So he has that license with CMHC, and he has the relationships with the pension funds to write those. And generally, Andrew's rates for the mortgages that he can get for apartment buildings and commercial are, apartment buildings specifically, because that's CMHC oriented, is about 60 to 80 basis points below what you'd get from First National or from RBC or CIBC or someone like that, one of those banks. The reason that
that's the mortgage broker fee that you're discussing, or that's the
no, it's the actual interest rate that you pay.
Okay.
So 60 to 80 basis points is quite a bit when you're thinking about a 10-year mortgage, right? I mean, it can save you a ton of money. So that's one thing that people, a lot of developers look at is they go to the bank and the bank says, well, it's 2.5%. Well, actually, if I go to Andrew, it's 1.8%.
And Andrew is getting that funding through a CMHC, or he's just
exactly the same funding. It's just that he has a different, because of his infrastructure, he has a lower rate that he can pass on to investors because he goes direct to the pension funds. He's not syndicating with other banks, and he's not using internal capital.
There you go. There's a good golden nugget to take away.
No, for sure. And CMHC, in essence, is there to be able to create more rental units to be available for people, which they're offering these low interest mortgages to developers to borrow from them, for example, for a 10-year period, to be able to then have the equity to be able to start building and constructing. But the caveat to it is that buildings have, just like you mentioned, have to stay tenanted, and at times there's also I believe there's a rental, there's a max kind of rental amount that's required, or what have you, I believe.
Yeah, so it depends on the type of CMHC mortgage that you go after. So in essence, CMHC is like Fannie Mae or Freddie Mac in the U.S., right? It's the mortgage insurance company that's owned by the Canadian government, and so mortgages backed by CMHC through their insurance are much easier to transfer. They do have a lot of restrictions, but all commercial mortgages have very similar restrictions. The difference with CMHC is, yeah, you pay a premium, but when you work out the numbers over time, we're still saving about 3% on the money that we would pay out to for the interest, based on the interest. So there is still a savings. CMHC is slower to deal with, so that's one of the challenges with CMHC. But you save a lot of money over time, so it is worth it for sure. I mean, there are CMHC mortgages going out now that, well, I think it's gone up a little bit now, but they were going out as low as 1.3%.
And is that interest only, or that's interest and the principal? Usually for these,
interest only.
Interest only.
Interest only, yeah, and then you pay.
That's beneficial to a developer when it's interest only. So maybe.
Oh, no, sorry, that's they're interest and principal for sure, yeah. You're talking about the payments, yeah. Okay. Yeah, the payments are P&I payments for sure, yeah.
Got it, great. And so maybe you can talk to us about a project that you're working on currently, or a recent project that you closed on, and the structure of how the syndication works. You also discussed that the plumber next door could invest with you. Are you servicing non-accredited investors? And tell us a little bit more about the process and the project you're working on currently.
Yeah, so currently we're friends, family. We're under the BCSE exemptions of friends, family, close business associates, and accredited investors. Shortly, we're working on this right now. We're coming up with an offering memorandum that will allow basically anyone to come and invest with us. There's going to be a ceiling of about $30,000 for non-accredited investors. But of course, offering memorandum or not, accredited investors can always come in and invest whatever they have capacity to, or where they feel safe investing in a new relationship. Yeah.
Great.
And so we have investors who've come in as high as 600,000 and others that have come in at $10,000. So, it's, we bring investors in on a case-by-case basis. Yeah.
Great.
And why don't you go ahead and tell us a little bit about the project that you're working on right now?
Yeah, so the current project is 𝗖𝗪 𝗖𝗽. It's a 32-unit apartment building.
Okay.
So what we did is this is in the Victoria Capital Regional District. We identified a location we really liked, and we liked it because it was a growing community. It has a lot of, and the municipality is very developer friendly. So they're very bullish on development. And so it was quite easy. And the area that we bought land in was essentially pre-zoned for what we wanted to do. So we're not going into the city and asking them to make exceptions for us to do a 6-story building in an area that isn't zoned for that. So the area that we're building in is zoned for the use that we applied for. So it's very easy to get it accepted. Then what we did, so we went in, we just started buying lots, but we did it unconventionally, right? We didn't go and look at the listings. And I said to the realtor, I don't want anything to do with the listings. I want to go knock on doors and I want to talk to people and buy their land. And so that's what we did. We went and knocked on the doors of all the neighborhood, and we just started, anyone who was receptive, we put in offers, and we started to acquire lots. So we bought 5 lots to begin with. We're working on 2 more lots now, which will complete another 5-lot assembly. We're going to turn that into another apartment building. This first apartment building that we're building now in that area, when we looked at the market, and I like to engage people who have knowledge about an area very early on. So we went to our property manager who manages a lot of the similar buildings that we're going to be building. And we asked her, Claire, what do we build? What are tenants looking for? And she said, here are the attributes that they're looking for. This is what's not being built that tenants are dying for. And we said, okay, we're going to add all those things into our building.
Nice.
And if it costs us an extra $200,000, so what? Because if we get 10 cents more rent per square foot, that's $800,000 right there in value.
Nice.
Great.
But most developers don't look at it that way.
Yeah.
They want to build the lowest cost,
Yeah.
and they want to provide their product to the audience instead of getting feedback from the audience and then providing what the audience wants.
Yeah, no, I love that. I love that we looks at it that way.
What stage is this project at right now? So you bought 5 lots. You're looking to buy 2 more. You're going to be building another project. And what kind of walk us through that?
Yeah. So with our first building is on 2 lots. It's squeezed pretty tight on 2 lots. We got 32 units out of it, and it is in rezone. So we've rezoned. We're in development permitting. We're just doing a variance right now. We have a variance on our side yard setbacks because we are parking squeezed kind of right to the edge of within 300 mils of each side, and we're supposed to be at a meter. So we had to do a variance on that. And once we're through that, which will be January 18th, is our hearing for that. And then we have a February 13th hearing for our final DP, and then we'll move into building permitting. So we should be in building permitting by early March.
Great.
Yeah. And at that point, we'll have engineer drawings all done, and we're going to be able to break ground right away and start foundations.
Exciting. That's going to be a exciting 2021 for you.
Absolutely. Yeah, I mean, we've already got the houses moved. So what we did is we lifted the houses off. We got Nickel Brothers. Do you, August, you know who Nickel Brothers are?
Yeah, I do. They pick up houses.
House movers. Yeah. So we had them come in. They lifted the houses and took them away for us.
Okay.
We didn't have to demo or anything. Saved us about 40 grand.
Were you close to water? Were you close to any water?
No, they just shipped them down the highway.
Oh, really? So they had to, and sometimes they have to take down wires. And if you're close to water, the house moving is a lot easier. A lot of times.
Yeah, they barge them out. Yeah.
Yeah, they barge them out. Or if you're building a house on a small island that Ava wants to buy one day, you can just rather than building and taking construction material, you can take one of these homes, and the people, the builders, the developers who are they're literally giving these homes away for free.
Oh, really?
Yeah, so
Okay.
Nickel Brothers, they charge a fee for moving the home, but the structure itself is free because the developer has to spend a bunch of money to demolish it for asbestos abatement and the demolition fee and a bunch of other stuff. So
Just between Rick and I, I'm gonna put that small island on my vision board.
There you go. Yeah, I want to see that on your vision board now that I heard about it. Yeah, absolutely.
And I love that you guys speak the same lingo. This is fantastic. You
for
both have
sure.
construction
No, he has
background.
much more experience than me. But go ahead. We have a question here
We do have a
from someone.
question from Sam. Thanks, Rick, for clarification. What data points, factors do you use to find the right cities, neighborhoods? Does that neighborhood that you are building in Victoria, is that in Langford?
Yes, it is in Langford. Yeah.
So that's in Langford.
Yeah.
And then what data points, factors do you use to find the right cities, neighborhoods?
I guess the fundamentals of job growth, population growth, but go ahead.
Yeah, there are some pretty basic fundamentals, which is job growth and GDP, all that sort of stuff. What I like to look at is what's the history of corrections in that market. And so I go back to the Canadian Real Estate Association has data that goes back a long time on market stability. And if you go through my pro forma, that data is all in there, right? And so I show investors, I compare a volatile market to the markets that I'm going into, and I show them what stability looks like. So when you look at Vancouver Island, Victoria, Capital Regional District, and Vancouver, that data trend that goes up, it's just a little bit of a squiggly line. There's a flat section after 2008, very little correction, and then it just takes off again. And if 2008 was any indication of what a bad correction looks like, then I think we're pretty safe.
Yeah,
When you think about how Vancouver and Vancouver Island fared, and when you look at the data chart, those data charts, Vancouver Island, Victoria, Vancouver, they all perform exactly the same. So it doesn't really matter where you invest. If you can buy land in a place on Vancouver Island or in the Lower Mainland, where when you run the numbers on your construction costs, your land costs, your holding costs while you're in development, permitting, and if you can come out of all of that and end at occupancy, if you can cash flow and you get a decent return for investors, it's a project worth doing. And so there isn't really a specific area that I would say works. It's a well, other than I know that Vancouver Island works because I've done the numbers on Vancouver Island. Some areas of Vancouver Island aren't going to work because I don't think that the rent revenue is up high enough yet to cover all the costs. But there are quite a few areas that are. Nanaimo is one. Cowichan is really close. It's getting there. All of the Capital Regional District of Victoria is good. So it doesn't matter where you go in Capital Regional District, the numbers work. The land cost is low enough, and the lift on the apartments is low enough based on the NOI over cap on the revenue. So it works really well. Yeah.
Great. Thank you.
We're going to plug along and continue building.
For sure. And if anyone has any questions, please write it in the comments section, and we'll ask the questions. We had our friend Chuck earlier, and this is going to be recorded and then posted on YouTube. So it's best to write that. So please, if you want to.
Yeah, so here's the next question, Rick. Let's just let this person in here.
Yeah, I'll let him in.
So
go ahead.
Mohammed says, I'm currently looking to start my first multiplex. I have looked into Sudbury, North Bay, and Windsor areas. What areas would you recommend now?
Sudbury, North Bay, and
Windsor.
Yeah. So, and sorry, what was the other one?
And Windsor.
Okay. Well, I know Windsor really well. Sudbury and North Bay. I mean, so I have a good friend, Nichelle, who you met this morning, Ava, who's invested in Timmins, and he's been in Timmins for about 10 years now. He's got over 200 doors in Timmins now, and so Nichelle has done very well in Timmins. I believe Sudbury is very similar. Windsor is good, but cap rates are compressed. That's the challenge with Windsor right now, is that I think there's opportunity coming in Windsor. I know there's a bit of a squeeze. Some of the undermanaged properties are having trouble now because of COVID. But I mean, I just picked up a property there. There was a commercial property that we're converting from its previous use, which was some commercial businesses. They stopped paying rent. We got a good deal from the owner because he just wanted out. He was older. It was a private deal, not listed, and we picked it up for $450,000, which was a bargain. And we're going to turn that once we get it all, the renovations all completed, get it tenanted. We're going to be valued around $2 million on that property.
Oh, fantastic.
Wonderful, wonderful.
Yeah. So there's lots of opportunities. It's really just, you got to get out there and run the numbers.
Yeah, great. And I got to share a little bit of a story here because we come from the same background, and prior to CPI and you know, investing in the US, my focus was development, syndicating deals here locally to do development projects, multifamily. There weren't the final goal wasn't multi-tenant; it was to build and sell. So it was a bit different than your process, Rick. But what I was noticing is great deals would come my way, and Canada is a vast country, second largest country in the world. And just like you say, you're speaking about Victoria, and you know, you're speaking about Ontario. This place is like 6 hours flight by plane. So they're drastically different markets. You know, it's difficult to kind of just take an hour-long drive and learn about them. And the syndicator, the sponsor, needs to you know, have a lot of information and familiarize themselves with multiple markets. Good thing is that you're based here in the Vancouver area, correct?
Absolutely, yeah.
Yeah, but you also have you know, you've done projects in Ontario before, so you kind of are very familiar with these areas. But my issue was that when deals would come to me, a deal would come in, you know, on the Vancouver Island, and I had to go and familiarize myself with the area. I had to understand the cap rates and you know, the demographics and what have you. So that's where we came up with this concept of partnering with our regional asset managers in the US who are experts in certain areas that we want to be in, and they basically are asset managers in that region. So that was kind of, I just wanted to kind of throw that in there. But we have some more questions here for you.
Yeah, and I agree with you that you know, so really it's about creating a beachhead somewhere, right? And when you moving to Windsor, to invest was a strategic move for me, because I knew the town was big enough to support the scale that I wanted to build in order to become financially independent in one town. And so I was able to do that, focus on that one town, buying property after property, leveraging from one property to the next, and bringing in investor partners, and build a big enough portfolio that I could hire property managers, hire employees to do the property management. And the game changer for me when it came to hiring employees in Ontario, because in Ontario, you can hire a paralegal and they can work directly for you. That was the game changer for me. As soon as I got a paralegal in my business, it changed everything, and it just became so much easier. So go ahead with the questions. Sorry about that, August.
No, that's totally fine. Go ahead if you like.
Looks like Sam right here.
Maybe we just do the last one
Right
here.
here. Okay, so thanks. Sarah says, thanks for providing the great information. What is equivalent of CMHC in US that you mentioned?
Fannie Mae, Freddie Mac.
Oh, yeah.
Fannie Mae and Freddie Mac, yeah.
Okay,
Great.
and there's another one here. Maybe we'll ask this one. I'm just trying to think here. Do you have any development or acquisitions in the US, considering the numbers are much better there? If not, why?
For the US, you got to come to us. So
yeah, he's Canada or the US.
Yeah, I don't do anything in the US, only because I've just found so much opportunity in Canada. I just haven't had I know lots of people who do, but it's not for me, because I'm having a great time in Canada. I don't want to complicate my business. I'm going to keep it simple.
For sure, and it's making sense for you. I mean, you're finding great deals across this nation. It's 40 million people in this country, 300,000 immigrants come into this country every year. The majority of them want to live in Ontario or BC. So it's just a money-making machine if you know where to invest and what to invest, and just follow the basics. So there's definitely opportunities here in Canada.
What is the minimum percentage of project cost in equity by promoter to get loan sanctioned funding before roping in investors?
Oh, so are we speaking to a construction loan, loan to value?
I think it's probably, so let me just read this. What is the minimum percentage?
No, I'll tell you, sir, what I meant was, let's say I want to do a project myself.
My friend, please, this is going to go on YouTube, so please write your questions down here. It makes it a bit difficult because we're going to have thousands of people around the world to watch this. And Rick is available. I'll share,
we'll share
Rick's information. You can get in touch with him. But our friend Chuck, please try your best to ask your questions on the writing. You were also available on the last webinar, but unfortunately, you were asking your questions. We will try to have certain webinars where everybody can discuss and network, because this is also hosted through our meetup group. So we will share. I'll actually
my email is on the backdrop right there. So
there you go. And his phone number. You can call him directly, Chuck.
Yes.
Feel free to call me, email me, whatever you like. Yeah.
He likes calls late at night. So the later you call him,
early in the morning, late at night. I'm an entrepreneur. I'm up anyways.
You better be careful what you say, because sometimes people like, hey, so you're available this time.
Let me just ask one more thing here. So, this kind of brought a new question in my mind before I lose it, because we have some other questions for you. But
yeah.
So I'm guessing you're very agnostic when it comes to the markets you want to be in. So if a market is doing well, like for example on Victoria, we all know that they have a very low vacancy rate. Langford, close to Victoria, we know that there's a need. Do you follow the trends of seeing where is a great place to invest? Let's say the oil boom would come back to Alberta. Would you consider building and developing as a syndicator developer in other areas rather than just the Ontario and Vancouver Island area?
So what I'm looking for in a market is anomalies, not cyclical trends. So timing the market is like going to Vegas, right? And I'm not a gambler, I'm an investor. And so that's why that's why I went to Windsor, because to me, it was an anomaly. It wasn't, there was no history of that ever happening in Windsor in the past 50 years. So I looked at why did that happen in Windsor? There were two reasons. The financial crisis affected Windsor in that the automakers shut down their factories. And then the other thing that happened is the dollar went to par. And it was the first time since 1960 something that the dollar ever went to par. And what happens when the dollar goes to par in Southwest Ontario is that manufacturing pulls out of Southwest Ontario because there's no economic advantage anymore, and it goes back to the US or it goes to Mexico. So that's what happened, is that the manufacturers all pulled out of Southwest Ontario. They went back to the US. When the dollar went back to disparity again, which it normalizes usually around 20-25 cents to the dollar, right? As soon as that happened again, all the manufacturers ran back to Southwest Ontario and they started up their factories again. And then, of course, the population came back, all the units got filled, vacancy rates went down, and value went up. And so that's the anomaly that I bet on, and it was the right move. And nothing's happened since, and I don't expect it will, because that sort of crisis, is it going to repeat itself? Probably not.
But if there is a kind of sub area that has an anomaly in it, which will create that need for development projects, you'd be more than happy to look at those areas. I'm
Absolutely, yeah. So I see the oil country. To me, it was always too big a risk, because it had a history of volatility. Not like Windsor. Windsor had no history of volatility. It happened one time, and that was after 2008. But when you look at the volatility of Alberta, Calgary, Edmonton, it's a roller coaster ride. So you got to be really careful there, because if you buy too high and you hit the next correction, because there always will be a correction because there's a history of it. You're going to be underwater, and you have to be able to tread water, right? So if you buy too high and you're in too deep and you're overfinanced, you're over leveraged, then and I know people who lost everything in Alberta because they over leveraged their properties. They were too confident. They didn't leave enough on the table, and yeah, they lost their portfolios.
And just before we get into this, Ava has a question for you. But I just want to ask you a question about the process of your development. So you locate an area that you want to build in. You syndicate a deal, so you raise the capital from investors. You guys buy the land. You go through the rezoning if need be. You construct the project. Loan comes through CMHC in most cases, and now the project is built. Do the investors at this point have a exit strategy, or they're with the project for the term of the project? Kind of talk about that to us, because our projects are like 3 to 5 years value add and we're exiting them. But with these multi-tenanted rental properties that are built, they're either sold to a REIT, but some investors keep them as their legacy asset and they're in it because these things are cash flowing forever from that day on. Yeah.
So our investors, once they're in, they stay in. They have the option to stay in for the life of the hold. Now we can sell the property at any time and take the lift and then pay out investors based on their equity share. But they never lose their equity share. It stays with them for the life of the hold. Some other investor groups put a limit on the equity of 5 or 10 years or something like that. And then after that, they own the building. And investors get paid out at whatever that valuation is at that time. But we have no expiry on our equity. The other thing that we do is if investors like doing business with us, they're enjoying the process, they're making money. When we do an equity takeout on a project, or if we when we get that return, that initial return. So basically what happens is that you have a construction loan, let's say $10 million, right? You complete the building and you occupy it. So your cost, let's say, is $10 million. You've got your land, your soft costs, everything in there. It cost you $10 million to get to that occupancy stage. Once you occupy, you convert from the construction loan to the operational mortgage, which is likely for us is going to be a CMHC mortgage. Now we've got that lift from cost to NOI, right? So there might be a $5 million lift there. In that $5 million lift, we pay investors back 100% of their invested capital plus whatever additional lift they get on their equity stake. Currently, this 𝗖𝗽 𝗖𝗽 project that we're doing, the 32-unit project, the investor returns are about 168% on year 2. Wow. And so they'll get 100% of their capital back plus a bonus 60-some%. And then it's about 20% year over year after that for the next 10 years.
Wow. Okay. That'll blow out of the water any American deal we got.
Well, but August, it's the difference is that it's a new build and not an acquisition and lift on and repositioning. And my acquisitions and lifts and repositioning, I got a few of them. I had around 100% return, but it took a lot longer. It took more like 5 years to get that 100% return. With a new build, I can do it in 2 years, 3 years tops. Depends on the city, right? So some municipalities, they take longer to get through, and you might go to 3 years, but generally it's 2 to 3 years.
Great.
On that initial lift.
Thanks for sharing that.
Yeah, maybe we can switch up a little bit our conversation now. As everyone knows, me and Ava have a big focus on education. We run our meetup group. We have our weekly webinars when we bring on experts, just like Rick, to kind of speak about real estate investing and this
alternative investments and building wealth.
Yeah, so this is huge for us, and we really enjoy connecting with people. And if you guys would like to talk about that part of Rick's business, where giving back and teaching others and helping investors. Right. So
absolutely, that would be great. Why don't you go ahead and tell us a little bit about Synergy Ren?
Yeah, so the logo, it's on this side, sorry. The logo here says Synergy Real Estate Network. we're a meetup group, and there's about just over 1,000 members. We've been building that for about 7 years now. And I hosted, there were chapters before, and there was a Burnaby chapter, there was a Richmond chapter, and I hosted the Langley chapter. But all the same people would go to the different chapter meetings. So we just decided to do one meeting after a while. And we, like we talked about Andrew Bennett, right? Andrew Bennett, Nexus Investments, the guy who does the underwriting through the pension funds direct to CMHC. He came on and talked about all the ways that he can help investors to finance at a lower rate, and how and what the numbers is that he needs to see, and all the different deals that can be done, and huge value for investors. Recently, we had Julie Hoffman on, who's the founder of the Okanagan Real Estate Investment Group. And Julie has courses, mentorship courses that she teaches on how to get investors that want to get into the market, but maybe they're in a day job, they need some help, and they don't have a lot of time, they got kids and everything. And so she helps them to narrow their focus to what's really important, and gives them the tools to focus them on the steps that really are important, and not be distracted by a lot of other stuff. And she connects them with the right people, helps them analyze the properties. So she, a person like that. So when you come to Synergy Ren, and you come to our events, those are the kind of people that we have hosting or doing presentations at our events. Sometimes it's lawyers on corporate structures, like my lawyer Don Deans was on, along with our accountant, and they talked about the corporate structures for investors for tax efficiency, and to mitigate risk, right? And then how to syndicate, all that kind of stuff. And so those are the things we teach at Synergy Ren. Yeah, huge value for investors. It doesn't matter what level you're at. You can be a beginner or a seasoned, you'll get something out of it for sure.
Well, if you ever need anybody to educate on investing in the US, you know who to call.
Right there.
Exactly. And for you guys, yeah, you're the experts in the US. Yeah. So come to Synergy Ren for Canada, and you guys for the US. Absolutely.
Absolutely. And how often is your guys' meetings? And is it held currently?
Last Wednesday of every month.
Last Wednesday of the month. And currently is it via Zoom currently, or?
Yes, it's via Zoom.
Awesome.
Yeah.
Awesome.
Fantastic.
Great. Yeah. So if anyone has any more questions, please go ahead. We really enjoyed our time with Rick, and we'd love to have you on again when your project kind of moves a bit more forward. When you do have your offering memorandum created are you creating an offering memorandum for this project that you talked to us about?
The new project, not the 32 unit. The 32 unit building is fully funded. So there was a $3.2 million raise. We raised that in about 4 months. And so we're moving on. So I've tasked the team with creating the offering memorandum, and then adding a zero to our $3.2 million.
Yeah.
The offering memorandum, because zero is a very insignificant number, right?
And I have to say, Rick is, and I love that you said that to me before. Rick is one of the most positive people I've ever met. Just speaking to him, he puts out that energy out there, and it just makes your day. So thanks for coming on and sharing your energy.
Thanks, Ava. Yeah, I really appreciate that compliment. Yeah.
Definitely appreciate it. Thank you, Rick. Wish you all the best, and thank you for taking the time. And I hope everybody enjoyed it, and have a wonderful day, everyone.
Have a wonderful day, everyone.
Right. And Merry Christmas to you guys, and Happy Hanukkah, whatever it is, and all the best for a prosperous and healthy 2021.
Absolutely. Thank you.
Merry Christmas, everyone.
Bye-bye.
Bye.
Bye.